Okay, good morning, everyone. Thank you for taking the time to listen to our webinar. I want to remind everyone that this webinar is being recorded. I'm delighted and grateful to have our guest speaker today, Peter Perkins, founding partner and global strategist at Macro Research Board, also known as MRB Partners. Macro Research Board is a privately owned independent research firm that provides integral global multi-asset investment strategy as well as actionable ideas. The Hortensio Group's views are very similar to MRB, who incorporate a long-term outlook based on in-depth thematic research together with a rigorous set of framework and forecasting models that drive 6 to 12-month asset market performance. Before I hand it over to Peter, I wanted to quickly go over what has happened over the last little bit since our last webinar in 2018. So prior to the last quarter, the markets were moving along with very little excitement and volatility. When October rolled around, that changed very quickly, as many of us all know. Issues and concerns about Brexit and whether the UK was going to have a solution with that, in the stalemate between Mr. Trump's building the wall and the government shutdown added to the volatility. The possible trade war that started to escalate between China and the US provided additional fuel to the fire as the market started to price in a possible recession and what would happen to the global economy if they couldn't work things out. The year didn't end well for major markets based on these issues and concern. So 2019 was rang in with a lot of cautiousness and worries for investors, but in the end, well, as of now, cooler heads have prevailed. And now look at where we are in the month of January. So I'll quickly recap. In 2018, the S&P TSX was down 11.6%, and as of January, it's now up 9.1. The S&P 500 was down 6.2, albeit in Canadian dollars because our dollar was a little bit weaker. It was actually up 2%, but now they're up 7.9. The MSCI, which is the Europe, Australasia, Far East Index that takes out North American markets, was down 16.1, and now it's up 6.5 in just the month of January. Emerging markets also had a challenging year, down 16.6. And year to date it's up 8.7. The bond index was in Canada was up about 1.4, and year to date we're up 1.34. Oil was the biggest one. It was down 24.8%. It transitioned from from being positive to a bear market during those months, and it was down 24.8. But year to date it's up 18.5. And our dollar has hovered around the 136, 131. In the government bonds, 10-year government bonds are floating around 1.97, and today 1.88. So you can see that, as I mentioned, cooler heads prevailed, and what we're going to talk about is what to expect for the upcoming year. Now I want to hand it over to Peter, who'll provide us some great insights into the year ahead, and he's going to take a look at and discuss, the questions about a recession or no recession, what to look out for, their views on China, key risks to monitor, and as mentioned, the economic outlook for this year. As mentioned, Peter is a founding partner at MRB. He has a Master of Economics from Pennsylvania State University and a BA in Economics from the University of Maryland. And with the aid of modern technology, Peter is joining us remotely from England. So thanks again, Peter, and the floor is all yours. The presentation is all yours.
Okay, thanks, Frank, and thanks for the opportunity to speak with you and everyone else today. As you mentioned, I want to provide a brief outline of the economic outlook for 2019 and what we think are the implications for capital markets and investment positioning. So there's a lot to cover. I'll have to go through things relatively quickly, but let me just start by seeing if I can get my screen to work. Right now I'm struggling with. Can you move me to the next page? For some reason, there you go. So let me start with a couple things. First, I want to emphasize we remain relatively upbeat about the global economic outlook, at least based on conversations I've had with clients and and what we read in the press and so forth, we're still on the more positive side, and I'll touch upon that in a moment. And from an asset allocation standpoint or investing standpoint, we still have a moderately upbeat view. We're slightly overweight equities, we're underweight in government bonds, and we're neutral in cash and commodities. And of course, the latter has important ramifications for the outlook for Canadian markets overall. I also do want to acknowledge there are a lot of things to potentially get worried about. After all, the U.S. economic expansion is almost 10 years old, and there are a number of political challenges around the world, including in the U.S. and in a number of countries in Europe. And as Frank mentioned, I'm living in the UK, and obviously Brexit sticks out. So, but there's also a lot of false narratives out there, and I think it's important for investors to be careful. You have to be informed, and you got to be skeptical sometimes. If stuff sounds like it's probably not true, there's a good chance it won't be. So, at this stage in the cycle, there's a lot of news flow out there, and you need to be careful. The other thing I want to mention is that markets, of course, are discounting agents. So, a lot of the things that people are worried about that we've been talking about, including in the fourth quarter, have actually been around for quite some time. That is, it's not really new news. There was a mini panic in the fourth quarter. Investors grew increasingly worried about global growth and rising U.S. interest rates. We thought that it was a panic, and that's largely what it was. And as Frank mentioned, it's dissipated to a considerable extent since then. But it is a reminder that there's a lot of investor skittishness out there. So, we have to be careful that markets can go down or quickly back up in a short period of time, because there's just a lot of anxiety sitting out there. So let me just start with an overall framework for the global economy. And the way we look at things is really to focus on what we call the three-legged stool. So that is the U.S., Euro area, and China. That's what drives things, and that's the view that you need to have in order to understand how you think about the world. So in the U.S., and again, I'll touch upon this in a moment, growth is slowing, but it's likely to remain above potential. In other words, it's going to grow a little bit faster than what the ordinary run rate is, and that's a little bit under 2% growth in the U.S. So, unlike a lot of other people, we don't really see big economic problems looming in the United States anytime soon. There are some other challenges politically, but not underlying economic problems. In the Euro area, growth slowed a lot last year, but we still think the foundations for ongoing economic recovery should persist. And actually, we think growth is going to get a little bit better this year than it was last year. Now, that's in contrast to what other people are forecasting, but dynamics, I think, suggest that we're probably in the bottoming process now, and over the course of the year, things will get a little bit better. On the China front, growth is also slowing, but I don't think there's any signs of stress that suggest that there's going to be the big blow up that people have been talking about for years. And in the rest of the world, there are a number of vulnerable spots. And one of the things that we want to mention is there's a lot of commodity markets that got blown up earlier this decade. There's a lot of over-leveraged markets, and we would include Canada in that. So there are problems elsewhere around the world that could either, exacerbate economic downturn or cause some problems. But again, focus on China, the U.S., and Euro area. And as always, the U.S. remains the main thing to focus on, or at least the initial point to focus on. So on slide 3, a couple of quick observations. On the left-hand side is a measure that we use, what we call a checklist indicator for recession in the United States. As you can see, it's very low. It doesn't tell you the probability of a recession per se, but it's very low. We're not seeing the kinds of signs that suggest that real problems are surfacing and that the odds of recession are high. Now, things can happen quickly, and that's what the past tells you. But right now, I think a lot of the anxiety about recession risks in the United States are wildly overblown. On the right-hand side, just as a reminder, the employment chart, which you can see in the green line on the top, employment growth, and we saw this last Friday, very strong. The job market is healthy. Unemployment, both the level and the unemployment rate are very low in the United States. Those, of course, are lagging or coincident indicators, but there's no signs yet that there's any real problem in the job market in the United States. The consumer, on page 4, is in very good shape. Consumer spending is pretty strong, right? 3.5%, 3.25%, that's perfectly fine. Income growth in real terms is also solid. As I mentioned, the job market, you can see some indicators on the right-hand side on page 4. Employment growth is strong, and forward-looking indicators of the job market also remain strong. Consumer confidence took a little bit of a dip in January, I think partly in December and January, but I think partly because of the government shutdown. But consumers are pretty upbeat. And if we just step back and think about the American consumer, actually things are the best they've been in a decade. So, you know, you always have to be mindful of how the consumer is behaving, but with a healthy job market, healthier balance sheets that have been than in any time in the past decade, and confidence levels pretty high, interest rates are still low. There's nothing out there that tells you the consumer's about to wilt. And by the way, you know, gas prices are low in the United States, and that's always something Americans appreciate. So nothing on the horizon in the U.S. that we've seen. The consumer looks solid. I'll touch upon some other risks later.
How about inflation? Is that a concern? How about inflation? Is that a concern?
Well, actually, the surprising thing is I think it's a slightly bigger concern than the market is giving it credit for, but maybe not for the consumer, because inflation at the headline level is low and going to fall because of the decline in oil prices. Where there is some inflationary pressures, actually on the wage side, wage pressures are intensifying in the U.S. So that's actually helping consumer incomes. And in the meantime, because headline inflation is falling, the consumer is getting sort of a double benefit. Now, at some point, if that persists, the Fed's going to have to reevaluate their dovish stance more recently. But right now, inflation is actually working in favor of supporting consumer spending in the near term.
Okay, great. Thank you.
All right, so let's just look briefly at the European economy on page 5. There's been a lot of anxiety about Europe and the slowdown that has existed over the past 12 months, and there's no sign yet that it's turning around. Momentum has downshifted a lot. You can see in that chart the manufacturing sector, that's just the dotted line's a proxy for the growth of the manufacturing sector. And right now, manufacturing isn't growing. It was growing at a very rapid pace at the end of 2017. It has slowed a lot, and GDP growth is slowing a bit from what had been a pretty healthy level, and that economic sentiment measure is also weakening. But the economic sentiment measure is worth looking at. It's not like it's depressed. It's coming off a high, and it may come down further. But we think that the fundamentals for Europe are, from a cyclical standpoint, okay. Europe, you have to remember, when it grows 1.25%, that's about not as good as it can get, but that's about its normal run speed. So, you know, you can't quite compare it to Canada or the United States. It just runs slower more generally. When you look at it, there's a lot of divergences across country. You know, Germany has been really quite strong. It slowed down in the past year. There's some concern that it might be falling into recession. I doubt it. But fundamentals are actually pretty good. The Netherlands and Spain, all of those economies still look like they have room to run. And in places like France and Italy, the recovery, economic recovery, is still in its early days. Both of those two, I was in Paris last weekend, you know, both of those two countries are struggling. And, you know, in France, there's lots of sales on and things like that. But in point of fact, they've got some political vulnerabilities. If those can get cured, I think the economic recovery is going to get back in place. Europe is an area to watch because it is the most vulnerable, and there are some policy risks. But our underlying belief is that as long as the U.S. and China continue to grow, and we get some relief on the trade front, and I'll talk about that in a moment, Europe will probably sort of muddle through. On the China front, you know, just some bullet points, and I just want to reiterate them. Yes, the economy is slowing. China's undergoing a structural slowdown from what was a very rapid growth pace many years ago. It's going to continue to slow for a number of years. Yes, there are a lot of imbalances and excesses. We all know that. We've known that for a long time. There's a lot of debt, and it has increased markedly in recent years, and that has to increase risks. The trade pressure from the U.S. is an unambiguous negative. At the same time, the central government is liquid and solvent, and they're working furiously to support growth, and we think they're likely to achieve success. That means not that China's going to be growing at 8 or 10% again, but that it's going to be a controlled slowdown rather than something that it looks more like a bust. We still don't see the catalyst for a bust. So China is going to still contribute to global economic growth, not as much as it has in the past, but we still don't see the basis for thinking China is in real trouble. As a general rule on page 7, just a note, monetary policy, there's been a lot of debate about this. The fact of the matter is, monetary policy in the United States, in Canada, in Europe, in China, in almost everywhere is still easy, right? Growth is well above what interest rate levels typically are. Monetary policy is easy, and the Fed's move, a week and a half ago was a reinforcement that they're going to support growth. Growth conditions are being supported by the central bank in Canada, in the United States, across Europe, in the United Kingdom as well. Central bankers are supporting economic growth. That's a positive. And I think a lot of people have gotten overly worried about tightening monetary conditions. Monetary conditions are helping to support economic growth and will continue to do so. There are a lot of risks to monitor. The U.S.-China trade war, as Frank mentioned, is important. We think there's going to be a deal, but until we get a deal, you have to say that there's risks associated with that. In the United States, I think we should not lose sight of the fact that, the Mueller investigation is ongoing. There are potential implications for Mr. Trump, and you cannot rule out a U.S. political crisis. It's hard to forecast at this point, but, if you get a circumstance in which the Democratic House has got Trump administration officials under constant investigation, there's a legal investigation from the Mueller team, it just doesn't make for a good environment, and everybody focused on the political climate means it's much more difficult for people to focus on the economic environment. So that's a risk. Obviously, Brexit is a risk. We could talk forever about that. I'm going to leave it aside for now. But, there are a number of political risks across Europe. Actually, I think politics was so bad in 2018 and in the first part of 2019, chances are decent that political pressures are going to diminish a little bit or move off the boil over the course of 2019, which of course will help the economic recovery process or rebound process in Europe, if we're correct. You can't be too sanguine, but you also shouldn't be too pessimistic about it. Oil prices are something that needs to be watched. If they are too low, it's a problem for the global economy in the short term, and obviously they would hurt Canada. Oil prices that are too high are a problem, and oil prices that are too low. We're sort of in the sweet spot right now, but we're not yet, or markets are not yet comfortable that they're going to be stable, and that's an important thing. And that's the same thing for the U.S. dollar. The U.S. dollar is in a stable environment today. We think it's going to soften a little bit over the course of the next year, but a big move in the dollar, maybe a big rise would be more problematic, but a big move in the dollar would be destabilizing rather than helping us to support an economy. We actually think the dollar is going to drift a bit lower. So we think the dollar is going to be beneficial for the global economy, but that's something that you have to watch. As Frank, you just raised, U.S. inflation is not dead, and the Fed may have to hike later this year. So, you could be whipsawed. But that's normal at this stage of the cycle. Policy changes can occur quite quickly. You can't assume that what the Fed said 10 days ago is going to last for the next year. But what you can say is the Fed is on the sidelines for now, and they're trying to support economic growth. We just have to be alert to the fact that inflation is not dead and could advance. And the final thing I want to mention about the cycle is, look, it's an advanced economic cycle. There are opportunities to take advantage of, but at the same time, you can't be too greedy because if you're thinking of a dog or a leash or whatever, you can't let the dog be walking 20 feet in front of you. You've got to have a relatively tight leash because there's just, it's late in the cycle and we're more vulnerable than we've otherwise been. So you can take some risk, but you also have to be cognizant of the fact that it is an old cycle. So let me run through a couple of capital markets things quickly. Again, Frank mentioned, I think this chart exemplifies exactly what we went on. The solid line that's up and down. At the end of September, everything was, clicking along well. Global stocks were rising, bond spreads were tight, oil prices were strong, and treasury yields were rising. And then suddenly everything went into reverse. And then, of course, at the end of December, they started to unwind. And that was an overreaction in the fourth quarter. People panicked too much, and people are recalibrating things in a more sober-like fashion today. How this is going to, or when this is going to play out, it remains to be seen, but it underscores that you can get big swings in a short period of time because the markets are not confident about the economic outlook. I think we are more confident about the economic outlook than the markets seem to be. A couple of other quick points.
Sorry, Peter,
Yep.
is it safe to say then, our clients and our listeners should expect a little more volatility in 2019 throughout the year rather than a more concentrated or 3-month experience that they had last year?
Well, I think it's reasonable. The answer is intuitively yes, but the problem is that what you can have, and I think momentum trade and algorithmic stuff that's going on means that you can have swings in markets, but they could be unidirectional until they get extrapolated fully and then reverse course. So for a while, so in aggregate volatility, but for a while you can have this unidirectional stuff because momentum trades, everybody hops on one train and then hops on a different train, as opposed to there's constant swinging back and forth. It's for a while it rides and then it reverses course. I think that's equally probable over the course of the year.
Okay, great. Thank you.
All right. So a couple of other things just to mention. Look, bond yields are still low by any historical standpoint. Treasury securities in the United States are still overvalued and very expensive by historical standards. Do not extrapolate the recent trend and assume that is going to persist. Swings can happen. And the other thing, a sobering message or cautionary message is there's a lot of emphasis in the press and elsewhere about the yield curve and the slope of the yield curve in the United States, which is shown on the right-hand side of page 10, with the adage that when it inverts, when the 2-year yield is above the 10-year yield, it's a sign that recession looms. That may be partly true, but it also, there's varying distance between, or time distance between when it happens and when you actually get a recession. But don't read too much into it. It's not an all-knowing, all-powerful signal. It's a signal that reflects a variety of economic conditions, and I think the market has read too much into it and too many people are reading too much into it. Take care in interpreting that. On the equity front, we had across-the-board pain in the fourth quarter. We've had an across-the-board rebound. Technology was the darling in the market until September and got hammered. Financials have been out of favor for quite some time. They're a crucial thing. Financials, stocks have to do better if our reasonably upbeat view of equities is going to be correct. They're rebounding a bit, but they're still in a tough way. That's something to be watching closely. Less so for Canadian bank stocks, for example, than for American banks. A couple of points on the U.S. earnings picture because that matters to everyone. Look, last year was a unique year because of the tax cut. We had big stock buybacks and so forth. Corporate profits were good last year, no question. The surprising thing was that revenue growth was very strong in the United States. That's the thing that I think most people underestimated and underappreciated. Revenue growth was very strong. Because we had the tax cut last year, but also because revenue growth was so strong last year, inevitably, it's going to be a more difficult year because both of those things are going to be less favorable in 2019. And that was, I think, a source of the anxiety in the equity market in the fourth quarter. But slowing momentum does not equal contraction. Earnings are not going to be lower at the end of 2019 than they were at the end of 2018. They're going to be higher. And as the consequence, that should provide some support to equities. Now, profit margins aren't going to be quite as good. In general, things aren't going to be as good as they were last year, which was a banner year. But as long as earnings continue to rise, and as long as the economic expansion stays on track, that provides considerable support for equities and is a foundation for being at least moderately upbeat about the equity market outlook in the year ahead. A couple of other quick things. One is, U.S., you can see on page 13 on the left-hand side the relative performance of U.S. stocks, so U.S. stocks versus global stocks, and emerging market stocks versus U.S. stocks. And in point of fact, after last year, a period when U.S. stocks did really well against everybody else and emerging markets did really poorly against everyone else, both of those conditions have turned around. It's not definitive yet in either case, and U.S. stocks have to do okay for rest of the world stocks to do well. But there are some signs that things are shifting, and that's important because sometimes when you get a big cathartic movement like you had in the fourth quarter, you get changes in momentum. So it doesn't necessarily just mean it's, wow, back into the U.S. There's some emerging trends out there that are important, and emerging markets are one of the most important ones. So let me just finish by looking at one other thing that's related to that. When you look at U.S. stocks versus the rest of the world, and U.S. stocks are an easy pick in many ways, but whether it's from an economic standpoint or from an earnings standpoint, both of those charts on the right-hand side of page 13 are intended to show that U.S. has done really well relative to everyone else, and it's hard to sustain that kind of outperformance economically and from an earnings standpoint. And maybe we're already even seeing signs of a reversal in the earnings side. So don't be surprised if, the U.S. is performing less well relative to the rest of the world over the course of 2019. And emerging market stocks are one area where we're pretty upbeat.
That's
right,
great.
So let me stop there.
Yeah, we also, we take a lot of our lead from research partners like yourself. So we definitely are taking that lead on, the view that other areas have to pick up the slack as, U.S. gets a little bit tired carrying the brunt of the weight over the last couple of years. And then the valuations in the emerging markets definitely seem like they're the best value over the long haul. So, so Peter, thank you very much for that great presentation. And, just to recap it, as you mentioned, the U.S., there's no real economic issues, just put some potential political issues out there. The U.K. growth is better. Oil prices need to stabilize and remain in the sweet spot, and investors have to be comfortable with that. And keep an eye out for financial stocks for your thesis to remain intact. They have to start to continue to grow on the global end rather than on the Canadian end. So hopefully I recap that based on your presentation, Peter.
Yep, good.
Yeah. And again, thank you very much. It was a great presentation, and hopefully we have you again. You're available for my clients again in the next couple of months as the need arises. If there's any issues that come up at that point, we will be calling on you, and hopefully you can make time again depending on the issues and concerns. So thank you for your time.
Certainly.
And, based on where you are in the world, you're probably getting ready for the weekend. So enjoy it. And thank you to all the listeners out there. And if you have any questions, give us a call, but we will definitely be in contact with you. Have a great weekend, everyone.